Good afternoon, ladies and gents. Welcome to the Monday weekly webinar on the 8th of July 2005 and a look at the key events that are likely to drive market movements this week. Hopefully you all enjoyed the weekend. I certainly did, watching Andy Murray win Wimbledon. It was always quite nice, and the British Lions winning the rugby as well. Nice little win double. Now all we've got to do is look forward to this week's beginning of the Ashes and the Test cricket. So I'm sure a lot of you will probably be watching that in between watching these markets. And it's been a fairly quiet start to markets in the wake of last week's non-farm payrolls numbers that we saw on Friday. And it was a bit of a choppy session, largely I think as a result of a little bit of uncertainty on the part of markets. With respect to, what this means for assets going forward. And we've certainly seen a positive start out of Europe today, despite the fact that we saw a negative finish on Friday. I think markets are sort of stuck between two stools at the moment with respect to the fact that does improving economic data mean that it's more likely that the Fed will withdraw stimulus? Well, I think it is very likely that the Fed will start to not withdraw, but certainly taper stimulus, and I think markets are a little bit nervous about that. Certainly bond markets are. Let's look at this chart here of the US 10-year. Now, the US 10-year on a weekly chart has traded above its 200-week moving average quite substantively for the first time since mid-2007, when it traded just briefly above it on two separate weeks in 2011. So for me that suggests that technically, from a technical standpoint, there's a good chance, as long as we manage to hold above this 256 area, which is where this line is here, then we're going to see a significant move higher towards 3% on US 10-year treasuries. Now, obviously, last week we also had some very important meetings from the European Central Bank and the Bank of England. And those meetings marked a significant departure from historical policy. Mark Carney, in his first meeting as Bank of England governor, despite the fact that we had some very good PMI data last week out of the UK, which points to much improved growth trajectories for the UK economy in Q2, basically suggested that interest rates would stay low for an extended period, a form of forward guidance, which basically cut the legs out from underneath the sterling rally that we've seen over the past few weeks. Now, what effect have those words had on UK gilt yields? None whatsoever. So if the intention of Mr. Carney in trying to talk the pound down on Thursday was to basically push yields lower, it's had the opposite effect. And really, I think he's basically pushing against the tide here with respect to rising gilt yields, because if the US economic data continues to improve, then US bond yields will drag bond yields across the globe globally higher. And irrespective of what the Bank of England decides or says it's going to do, that's going to basically have a follow-on effect with respect to UK gilt yields. Certainly if UK economic data continues to improve. And those of you who saw my tweet a few minutes ago about JP Morgan revising its growth forecasts for the UK economy higher, that does seem to be the direction of travel. Later this week, we are also expecting the IMF to revise its growth forecasts for the UK economy higher as well, which rather throws into credibility the status of that organisation, given the fact that Mr. Blanchard, chief economist of the IMF, suggested earlier this year that the UK was playing with fire with its current economic policies. And I think, judging by the timing of that announcement and the direction of UK economic data since then, I think it's 1-0 to George Osborne on that count. So going forward, I think the direction of travel with respect to bond yields does appear to be slightly higher. UK markets are slightly higher this morning. on the back of a late rebound that we saw in US markets on Friday. I think it's too early to read too much into the late rebound that we saw in US markets on Friday, simply because it was such a low volume day, given the fact that most of the US was probably still out enjoying their Budweisers and their hot dogs from the Independence Day long weekend. So I think it's too early to say whether or not markets are optimistic about improving economic data. They should be, but having said that, they've been on crack for so long with respect to stimulus. It's hard to say how they will react going forward to the prospects of further, or the likelihood of further reductions in tapering. And now let's talk about the tapering argument, because I think the key event this week is likely to be the FOMC minutes on Wednesday, and Mr. Bernanke is due to be giving a talk after those minutes on Wednesday as well. So when you factor that in, if he basically continues to pedal the line that any tapering is going to be data dependent, then a lot of people are going to be starting to revise their predictions for tapering from December into September. So that is essentially going to benefit the dollar, and we've certainly seen that with respect to euro-dollar. The one thing that has surprised me somewhat with respect to euro-dollar is how resilient it continues to be. Now, if we just quickly go back to my Bloomberg here, let's look at the economic data that we saw out this morning from Germany in particular. Industrial production month on month for May came in at -1%, which was way worse than expected, and the year-on-year figure was also subsequently way worse as well. Notwithstanding that, if we look at the trade balance data, the exports were down 2.4% for May, imports were up 1.7%, but that's the concerning amount for such an export-driven economy, down 2.4%, and the April number was revised down from 1.9 to 1.4. There is still an awful lot of concern about the German economic recovery, especially in light of the fact that we saw last week's manufacturing PMIs for Germany continue to struggle, even though Spanish and Italian started to pick up. And actually, Spanish manufacturing PMI actually finished above Germany's PMI for the first time in a very, very long time. So that points to me as to a bit of a dead cat bounce, certainly with respect to Spanish manufacturing PMI. Unemployment continues to remain significantly high, and that is really the main concern going forward. Even though the fundamentals of the Spanish economy are improving, they're recovering from a very, very low base. So they need to recover an awful lot more to get that unemployment rate down, and to also assuage concerns about the Spanish banking sector, which still remains significantly undercapitalized going forward. So let's look at euro-dollar. Just going to show you a quick graph. The reason why I'm surprised that euro-dollar is an awful lot lower is because of this chart here, which I'm trying to maximize. There we go. The yellow line is the spread differential between the 10-year US Treasury and the Bund, and it's at 7-year highs. Now, generally, these lines tend to move in opposite directions to each other. The white line is the euro-dollar price action, and as the price differential moves in the dollar's favor, euro-dollar tends to basically go in the opposite direction. They tend to basically pull apart because the attractions of owning dollars become more attractive relative to owning euros. And what normally happens in this case is that as the spread differential widens in favor of the dollar, the euro should go lower. That is currently not happening. Now, we have to look at why that's currently not happening. And irrespective of what you think about the US economic recovery, the Federal Reserve's balance sheet is still expanding at $85 billion a month. $45 billion of that is US Treasuries, and $40 billion is mortgage-backed securities. The ECB balance sheet is still contracting because of the money that's being paid back via the LTRO. And I think that is essentially why the euro is holding up as well as it is, even accounting for the widening spread differentials, but at some point that will crack. When that cracks, euro-dollar should go lower. At the moment, we're still finding support around about the mid-127s to the low 128s, but we have broken below this trend line from the April lows from Friday. We need to get back above that line to retarget the confluence of resistance on the moving average is of the 50, 100 and 200 day between 130.5 and 130.75. At the moment there's no evidence of that, but there's no real evidence of any particular flow trade this morning at all. So it's still too early to suggest that there's anything there's going to be any turnaround in sentiment. One thing I would say is that we are incredibly oversold. There is significant divergence on the daily oscillator, and that could suggest that we could see a bit of a bounce, but I certainly don't see any pullback in euro-dollar much above 131. I think we are headed lower. It could just take a while to unfold. If we look at the 4-hour chart, we can see similar divergence as well. Here we are starting to tick back higher. We need to get back above this 20% level. It does seem to suggest that we have found a bit of a short-term base, so we could certainly edge back up. But as I said earlier, it's going to be slow and it's going to be rather tortuous. And we've also got the 50 event moving average of the 4-hour chart acting as a bit of a cap, and has been acting as a bit of a cap for the last 3 or 4 weeks. So we could well get a test back to the 129.80 area without undoing the downward pressure that we're currently seeing on the chart at the moment. If I zoom that back out to the weekly chart, we can see once again how really dreadfully dull this particular currency pair is. The weekly momentum is pointing down, which does seem to suggest that we have got further to go, certainly in terms of downward pressure, but we could squeeze higher first, and I know full well that euro-dollar has a nasty habit of doing exactly that. From a technical standpoint, it's pretty much a similar story with respect to cable. Again, we're very, very oversold on the dailies. We had that technical breakout last week on Friday, below the trendline support from the lows at 148.30 that we saw in March. We are still currentently above them, and that does presuppose that we could see a bit of a short squeeze. I certainly see less reason to sell cable than I do to sell euro-dollar, irrespective of what Mark Carney says about forward guidance. I think we're going to have to wait until the inflation report next month to get any further clues on that. I think the policy meeting for August is going to be too early. The inflation report comes after that, and I think the September meeting could be particularly interesting in light of the contents of the August inflation report. So I certainly think September at the earliest before we get any further colour on further UK monetary policy. What I would say is that a lower sterling is not good for the UK. Some of the growth that we've seen so far out of the UK has been very much driven by the services sector. We have seen some increase or certainly better performance from the manufacturing and construction sector. But you have to remember 70% of the UK economy is services driven. The last thing we need is a lower pound, pushing up inflation and eroding the income, our average incomes of the UK consumer. And energy prices are heading up. We've already seen Brent crude push higher. If you get a lower pound, you're going to get higher oil prices. That's going to erode. It's going to certainly erode consumer incomes going forward. So I think these revisions higher of growth forecasts, while all well and good, I don't think they take into account the fact that if the pound does drop below this 148.30 area, then we're pretty much looking at fresh air until we get to 142.30, as can be seen from this chart here. There's really not too much between these levels here and the lows that we saw in 2010 at 142.30, which was just after the general election when the UK coalition government came to power. We could tick through 148.30 and come in at 147.80 as a bit of a support. That coincides with these lows down here, so we could get a spike through there. That's really the key level that I'm looking for on the downside for cable. We could take out a few stops below 148.30, but I would like to see and move below 147.80 before I get overtly bearish on sterling in the short to medium term. Yes, we are turning lower in terms of the weekly momentum, but in terms of the daily momentum, we are very negative, as we are also on the 4-hour chart. We're also very negative as well. And I think we need to wind some of that out before we go lower in the short to medium term. Looking at dollar yen, it's a similar sort of story. Despite the blow higher in US yields, we're currently struggling around about this 101.35 area. Having said that, we are now starting to trade slightly above my Ichimoku cloud resistance, and if we continue to stay above that, and the likelihood is we could, because we're now starting to turn over, we could well continue to move higher in dollar yen. But at the moment, we're struggling around the 101.50 area, and even though US yields are higher, they have slipped back a little bit over the course of the last day or so. But certainly a move in US yields up to around the 3% level will be positive for the dollar against the yen, and will eventually see a retest of 103.75. In the short to medium term, I do expect a little bit of a pullback to around about the 99.80 area, but I would be surprised if we break significantly below that. Also have to bear in mind, later this week we have got a Japanese rate decision, but I'm not expecting, that's on Thursday morning, first thing, not expecting too many surprises from that. We do have Japanese upper house elections later this month, and those I think will be very, very key in terms of the next steps of Abenomics and to whether or not Mr. Abe embarks upon the structural reforms that the market is hoping to see with respect to the next stage of that particular policy. One of the things I would say is we have seen an improvement in Japanese economic data, which does seem to suggest that the policy is working, and if the policy continues to work, it will encourage further yen losses, further Nikkei gains, and we could see further moves higher in dollar yen. But I think that story will play out more so over the next couple of months rather than the next couple of weeks. So that's the dollar yen. Looking at euro sterling, we can still throw a blanket over this broad range that we've seen, but the one thing I would say is the lows do appear to be getting higher. We do appear to be building momentum for a break higher. 86.35.40 is the key level from my perspective. I would also draw a trend line in here from the highs that we saw. Missed that, so let me just get rid of that and redraw that. Just move them out of the way. Alright, so that trend line comes in around about 86.50, so we need to keep an eye on that as well. So for me, what I'm looking for is a break above here to signal further gains in euro sterling. Do I think that we'll see them? I'm doubtful, because given Mr. Draghi's comments last week, given the fact that the subject or the prospect of further accidents out of Greece, Portugal and Cyprus is fairly high, I certainly think that the ECB has the potential to become more accommodative. Now, the question is, will that happen before the German elections? I think that they will fight against the wind there in terms of they don't want to do anything before then. But at some point, the pressure on these countries' finances will get to the point where the ECB will have to print. Now, when will that happen? It's hard to say. But until such times as the ECB's balance sheet starts to expand again, I think the upside is, the pressure is going to be on the upside, but I really wouldn't want to be owning euros at these sorts of levels. Having said that, the market probably thinks the same thing, which probably means that we're going to squeeze higher. But at the moment, we have a couple of technical factors keeping a cap on the top side. Let me just put those moving averages back in. 50 and 200. There we go. So they remain quite a long way away. To my mind, there is no fundamental reason as to why euro sterling should be as strong as it is, given the growth trajectory in Europe and the growth trajectory in the UK, and also the interest rate differentials on the gilt yields, certainly not in terms of the base rates, which are pretty much identical. Moving on, let's have a quick look at the US 10-year note on the cash price. As we can see from the 10-year note here, we have broken a 6-year uptrend on prices for the US Treasury, even if we haven't broken it on the yield chart on the Bloomberg. So that suggests to me on the price chart that we've certainly got potential for further losses. We've broken below the 200-week moving average. We've broken below the 6-7-year uptrend. That suggests to me that we could be building up for a further move down to around about the 120 level on the price, which is roughly around about 3% on the yield. Let's draw some Fibonacci's in there to get an idea of targets. Of course, I've missed it again. That comes from having lousy eyesight. I'm not wearing my glasses, and I should be. C'est la vie. They say vanity is a bad thing. It certainly is where I'm concerned. There we go. Let's draw that in. So we're looking at the next potential level, around about 123.95, 124. You can see that once we've broken below these twin lows here, we're on a bit of a downward path, certainly on the price action, and we really need to get back above this trend line and back above that to halt the downward momentum in bond prices. So the key question here is the bond bull market of the last 6 years, is the bond bull market in US Treasuries over? That's a good question. I think the potential is that it is, and we're going to see further bond price losses, which should see yields push higher on the 10-year. Similar sort of story on the UK gilt. Looking at the weekly chart again, we can see straight away that we've broken below the lowest levels that we saw in 2012. So there's a potential for further rise in yields there. Maybe not to the same extent as the US, because policy is going to be an awful lot looser. But having said that, if US yields go higher, then UK yields will go in the same direction. Okay, so that's the currencies. Let's quickly have a quick look at Aussie, because we've got some Aussie data out later this week, and there's certainly potential for further Aussie losses there on the back of the rise in the US dollar. Maybe Mr. Bernanke will play down tapering talk, and that could cause a sell-off in the US dollar. But at the moment, the technical picture on Aussie dollar looks pretty negative. We've broken below 91.50, which was my Fibonacci projection breakout of this channel here, 200% there. The direction of travel remains lower. There's certainly no indication whatsoever that we're seeing any change in trend in terms of the dailies or the weeklies, even though we remain significantly oversold on pretty much every single chart that you look at. Those of you who follow my blogs fairly regularly will know that it's trend that's all important and less about being overbought and oversold. The direction of travel remains down, will continue to remain down until such times as I have significant evidence that it's reversed, and at the moment there is no evidence that it has reversed. So you have to basically trade with the trend and look to sell the rally. That suggests to me that by the end of this year, we could well see a move back to these lows here that we saw in mid-2010 at 87.70. There's also the fact that it's highly likely that we'll get another rate cut out of the RBA between now and the end of the year, especially after Mr. Glenn Stevens' poor attempt at humour last week about the fact that the central bank deliberated for a long time about a rate cut. They had the assistant governor coming out with damage limitation the day after, saying they always deliberate a long time. But the direction of travel remains pretty much downwards in terms of Australian dollar interest rates, certainly more so given the fact that Chinese data this week is likely to point to a further deterioration in economic activity. On Wednesday, we've got the latest trade balance data. Keep an eye on the import and exports numbers. Don't read too much into them, because I think there's an awful lot of suspicion about data manipulation, but certainly the direction of travel, the fact that the Chinese central bank is cracking down on liquidity, it does point to a significantly slower pace of growth in China going forward, and that's likely to see growth forecasts revised lower over the course of the next 6 months, which means essentially that Australia's exports to China are going to slow down, and I would expect to see subsequent downward revisions there as well, which is going to weigh on the Australian dollar. So for me, the direction of travel remains down with respect to the Aussie dollar. That's not to say that we won't see significant short squeezes, but certainly the longer term objective by the end of the year for me is for the Australian dollar to be trading below 90. So that's the Aussie dollar. Contrasting that with what's happening with respect to Brent crude is, a bit head-scratching, and you can talk about what's going on in Egypt until you're blue in the face. The fact that people are worried about the Suez Canal being closed, I mean, please give me a break. The Suez Canal has only closed twice in the last 50 or 60 years. It's not in the interests of the Egyptian government or the Egyptian military for that canal to be closed, because it's going to hurt Egypt more economically than they could ever imagine if they're not able to guarantee that. So with demand remaining low within Europe and probably largely in the UK, it's going to be of negligible effect. What is even more head-scratching is the fact that US crude prices have gone to their highest levels for quite some time on the back of the Egypt crisis. I mean, come on, give me a break. US crude prices are completely immune from what's going on in the Middle East, because essentially US crude, they're entirely self-sufficient. They've got a lot of their exports, that they get a lot of their oil internally, inventories at record highs, and even if they can source their oil from elsewhere, they can get it from Canada. So there's certainly no supply constraints there. Inventories did slip back last week. That's not surprising. It's US driving season. It's when demand usually picks up the most. And also you've got some very, very hot weather in the US at the moment, which is putting upward pressure on electricity usage. What does that mean? It means that power consumption goes up. So that's not really too much of a surprise. So I think even though US economic data is improving, it's improving from a very low base. Jobs growth coming in 195K. A lot of those are part-time jobs. It doesn't mean that generally Americans have much bigger disposable incomes. So I think it's important to have a sense of perspective. So we could squeeze higher, but I don't expect US crude to go racing away too much. And one of the good things is that finally we're starting to see the differential between Brent and crude and US crude starting to narrow to much more realistic levels. I still think both prices are still way too high, but I certainly think OPEC have got a vested interest in keeping Brent crude prices above $100 a barrel, simply because the Arab states need it to be that high to keep their populations happy. So that's Brent crude. Let's look at copper. I mean, copper tells me really all I need to know with respect to what the economic growth picture in the global economy is like. It's pretty dire. If you look at the downtrend that's been in place since February, it's been pretty much one-way traffic, and yet UK and US markets and stock markets are continuing to remain fairly well bid, which tells you really all you need to know as to how the markets are positioning in terms of the growth picture. These markets are not being driven by growth, they're being driven by stimulus and nothing else. So the direction of travel remains down. If we break below this 298 area in the copper price, then we could well see further rapid declines. Certainly from this chart, we can see that there is an awful long way to go, and we could come back to the lows that we saw in 2010, and that area is a big, big support, as we can see from this chart here, around about the $2.70 mark. So certainly worth keeping an eye on those levels there as a key support for copper. Gold, our old favourite gold, that got absolutely trashed on Friday, but it does appear to be showing signs of forming a little bit of a short-term base. The key question for me, or the key level for me, remains this 1156 area. It's a Fibonacci retracement level. It's 61.8 of the entire up move from the 2008 lows at $680 an ounce to the all-time highs that we saw in 2011 at 1920. So you can see from the weekly chart what the direction of travel is. We are starting to, or we're continuing to trade lower. There is potential for a bit of a short-term base starting to come in. We're probably likely to remain under pressure while people speculate about Fed tapering. But I think going forward, the gold price, I think, will struggle to break significantly below 11.56. I would be surprised if we do trade significantly below that. Certainly the charts don't lend support to that argument, and the fact that everyone else is saying that gold price is going lower automatically makes me suspicious about the fact that it is going lower, because they're probably just talking their books. Having said that, if we look at our client sentiment, you can see that our clients are 75% long, 25% short. That suggests to me that we're probably not going to go too far anytime soon, and that we will struggle to get above 1320. And I think that's probably the likelihood is we're going to trade within a range from the lows that we've seen so far this year to the highs that we saw in the middle of last week. 1290, 1300, around about 1200. I'll be surprised if we significantly go either side of that. It's a similar sort of story for silver prices as well. As we can see from this weekly chart here, key level for the silver chart needs to get back above $20 for me to diminish the pressure on the downside. I think that's the key level for me on the silver price. $19.71, $20 really. Last week's highs. If we can get back through there, then we could well see a short squeeze back to around about $24 an ounce. Before I move on, does anyone have any questions? I'm going to wrap this up now. Don't forget this week's FOMC minutes. They're going to be a key factor in determining the US dollar's direction this week. Will Bernanke reiterate everything that he said at the last press conference, or will he be slightly more cautious and slightly more dovish? I think that's really the key market event this week, the FOMC minutes on Wednesday and Bernanke's press conference afterwards. Otherwise, unless anyone has any other questions, I'll wrap this up for this week and talk to you all next week at the same time.